A payment request arrived at Google, carrying a name the company knew, Quanta Computer. Facebook knew the name too. Across repeated transfers, the two companies sent more than $120 million. The emails looked familiar. The invoices referred to real business. The approvals were real. But the Real Quanta never received the money. It went to bank accounts controlled through a second company in Latvia, incorporated under the same name. The scheme did not need to breach Google or Facebook's servers. It changed one thing: where the money went. Same name, different bank, and for nearly 2 years, that was enough. Quanta Computer was not an invented supplier. It was a major hardware manufacturer in Taiwan, doing real business with both companies. That relationship was the camouflage. For an accounts payable team, a request carrying the Quanta name did not begin as an unknown outside threat. It began inside an existing vendor workflow. Beginning in 2013, Evaldas Rimasauskas and others built a copy around it. Rimasauskas incorporated another company in Latvia under the Quanta name. Accounts connected to the operation were established in Latvia and Cyprus. The duplicate did not need factories or products. It needed a legal identity, accounts capable of receiving international wires, and documents that connected the familiar name to those accounts. Then came the emails. They were made to look as if they came from the legitimate supplier. They did not ask an employee to send money to a stranger. They redirected payments the companies already expected to make. That distinction mattered. The vendor name remained familiar. The business relationship remained real. Inside the payment instruction, the destination account changed. And it kept working. Public reporting later put Google's transfers at roughly $23 million and Facebook's at roughly $99 million. These were not one-off mistakes. They were repeated payments moving through ordinary corporate systems. Transfers that large create questions. Banks want contracts. Compliance teams want invoices. Reviewers want names, signatures, and proof that the money belongs where it is going. Each layer can be performing a reasonable check while still inheriting the same false assumption from the layer before it, that the supplier identity is genuine. The scheme supplied all of it. According to the Justice Department, forged invoices, contracts, letters, corporate stamps, and executive signatures were used to support the transfers. When a bank asked for paperwork, the paperwork reinforced the same false identity. Those documents did not move the money by themselves. They answered the questions that might otherwise have stopped it. This was business email compromise, a fraud built inside normal business communication. The technology did not have to fail. The message only had to arrive at the right moment, carrying details that belonged there. And while the payments were still moving, the FBI was already warning companies about the pattern. In 2015, it described more than $1.2 billion in exposed losses from business email compromise worldwide. The scheme ended when Google's vendor management team detected the fraud and alerted authorities. By then, the money had not stayed in one place. Investigators traced funds through accounts in Latvia, Cyprus, Slovakia, Lithuania, Hungary, and Hong Kong. Each transfer added distance between the victim companies, the false supplier, and the people controlling the money. The trail was visible, but it crossed institutions and jurisdictions that no single reviewer could see at once. In March 2017, Rimasauskas was arrested in Lithuania. 5 months later, he was extradited to the United States. In March 2019, he pleaded guilty to wire fraud. He admitted helping orchestrate the scheme and moving the proceeds through accounts around the world. That December, a federal judge sentenced him to 5 years in prison. But even the indictment did not describe a purely solo operation. Its language was careful. Rimasauskas acted with others known and unknown. In court, he said other people had created forged documents. The public record does not identify every participant or establish what happened to each of them. It does establish something important. The emails, documents, companies, and accounts formed a system larger than one convincing message. The headline number was more than $120 million. That does not mean all of it disappeared forever. Google said it recovered its funds. Facebook said it recovered the bulk of its losses. The court later ordered Rimasauskas to forfeit nearly $49.7 million and pay about $26.5 million in restitution. Those are legal orders, not separate piles of recovered cash, so they cannot be added or subtracted to invent a missing money total. The remarkable part was not a mystery fortune, it was that ordinary purchasing, approval, and banking mechanisms moved the money again and again before the false destination was stopped. The method did not disappear with this case, the FBI says. Global exposed losses from business email compromise reached $55.5 billion between October 2013 and December 2023. In 2024 alone, victims filed more than 21,000 BEC complaints, reporting $2.77 billion in losses. Those figures measure reported complaints and reported losses, not every attempted fraud or every victim that remained silent. The most useful defense is almost embarrassingly simple. When a supplier changes payment details, verify the request through a known secondary channel, a trusted phone number, a separate contact, something the email itself did not provide. That separate channel tests the one detail the fraud must change while leaving everything familiar around it. Because the decisive weapon in this scheme was not code. It was a familiar name, a believable invoice, and one changed bank destination that nobody independently verified in time. Same supplier, same payment, different bank.